Most traders have heard of Elliott Wave Theory. But here's the problem. Many people learn the theory and still have no idea how to actually use it on a real chart. They know the names. Wave 1, Wave 2, Wave 3, ABC correction. But when they open TradingView, everything suddenly becomes confusing. So in this video, I'm going to show you how to use Elliott Wave tools directly inside TradingView. You'll learn how to identify impulse waves, corrective waves, and triangle patterns. You'll also see how Fibonacci can help you estimate potential pullbacks and future price targets. And most importantly, you'll learn the key rules that can help you avoid one of the biggest mistakes beginners make, forcing wave counts onto random price action. Let's jump into TradingView. On the left side of the chart, open the Drawing Tools menu. Then select the Patterns section. Inside that category, you'll find several Elliott Wave tools. The three we're focusing on today are the impulse wave, the corrective wave, and the triangle wave. Before drawing anything, let's quickly look at the settings. Every Elliott Wave tool can be customized. You can change colors, line thickness, labels, and visibility. But one setting deserves special attention. It's called degree. This controls the scale of your wave count. Smaller degrees are useful for lower time frames. Larger degrees are better for swing trading and long-term market structures. This matters because Elliott waves are fractal. In simple terms, smaller wave patterns often exist inside larger wave patterns. A 5-wave move on a 15-minute chart might only represent a small part of a much larger trend on the daily chart. That's why experienced traders often analyze multiple time frames before making decisions. Now let's draw our first impulse wave. Select the Impulse Wave tool. Then place the points directly on the chart. 1, 2, 3, 4, 5. That's all it takes to create the structure. You can always adjust the points later by dragging them into position. Now let's talk about what these waves actually mean. Because Elliott Wave Theory is really about market psychology. Wave 1 is where a potential new trend begins. At this stage, most traders still believe the previous trend is intact. If the market has been falling, many people remain bearish. Only a small group of traders begins buying. That's why Wave 1 often goes unnoticed. It's usually not obvious until later. Wave 2 is where doubt returns. The market pulls back. Traders start questioning whether the reversal was real. Some traders close positions. Others think the old trend is about to continue. One important rule here is simple. Wave 2 cannot move below the starting point of Wave 1. If it does, the wave count becomes invalid. This is also where Fibonacci becomes useful. Apply a Fibonacci retracement from the beginning of Wave 1 to the end of Wave 1. Many traders watch the 50% and 61.8% levels for potential support. Notice how often price reacts near these zones. Of course, nothing works perfectly every time, but they provide useful reference points. Now, let's move to Wave 3. This is usually the most exciting part of the trend. More traders start recognizing the move. Momentum increases. Breakouts occur. Volume often expands. And confidence grows. Many traders consider Wave 3 the most powerful wave in the entire structure. There's another important rule here. Wave 3 can never be the shortest impulse wave. In reality, it's often the longest. When estimating Wave 3 targets, many traders use Fibonacci Extensions. One common projection is the 161.8% extension. It's not a guarantee, but it's a level many market participants monitor. Next comes Wave 4. This is where the market pauses. Some traders take profits. Others hesitate to enter after such a large move. Momentum slows down. Price often moves sideways. This phase can feel frustrating because it lacks the excitement of Wave 3, but it's an important part of market structure. Another rule applies here. Wave 4 should not overlap the price territory of Wave 1 in a standard impulse pattern. If that happens, your count may need to be reassessed. Finally, we arrive at Wave 5. This is often where emotions become strongest. The trend looks obvious. News headlines support the move. Social media becomes extremely bullish. Many traders who missed the earlier waves finally decide to jump in. Ironically, this can happen near the end of the trend. While price may still rise, momentum often starts slowing down underneath the surface. This is why experienced traders pay close attention to potential signs of exhaustion. Now let's talk about corrective waves. After a 5-wave impulse move, markets often enter a correction. This is where the corrective wave tool becomes useful. Draw the structure as A, B, and C. Unlike impulse waves, corrective waves move against the primary trend. Wave A often surprises traders. Many people still expect the previous trend to continue. Then wave B creates hope. It makes traders think the trend is returning. But wave C is where the correction often completes. One thing beginners should understand is that corrections are usually messier than impulse waves. They often look less organized. And not every correction forms a perfect ABC pattern. One of the biggest mistakes new traders make is trying to force every pullback into a textbook structure. The market doesn't always cooperate. Use Elliott Wave as a framework, not as a prediction machine. Now let's use Fibonacci to estimate potential correction zones. Apply a retracement tool to the previous impulse move. Many traders monitor the 50% and 61.8% levels as potential correction targets. Then, if you want to project the potential end of wave C, you can use a Fibonacci extension. This helps estimate where the correction may eventually complete. Again, these are probabilities, not guarantees. Now let's look at another useful pattern. The Elliott Wave Triangle. Select the Triangle Wave tool. Then mark the 5 internal swings. The triangles often appear during consolidation phases. The market stops trending aggressively. Price compresses into a tighter range. Neither buyers nor sellers have complete control. As the pattern develops, volatility frequently decreases. Many traders view triangles as a sign that the market is preparing for a larger move. And in many cases, the eventual breakout follows the direction of the broader trend. This makes triangles especially useful when combined with higher timeframe analysis. Now let's cover some common beginner mistakes. The first mistake is zooming in too much. When traders focus on every tiny movement, they start seeing Elliott waves everywhere. That's usually a problem. Start with higher time frames first. Identify the dominant trend. Then move down to smaller time frames if needed. The second mistake is ignoring invalidation rules. If a wave count breaks a core Elliott wave rule, don't try to force it. Accept that your count may be wrong. Professional traders adjust their analysis when new information appears. The third mistake is expecting perfection. Elliott Wave Theory is not an exact science. Two experienced analysts can look at the same chart and produce different counts. That's normal. The goal is not predicting every candle. The goal is understanding market structure more clearly. And that leads to better decision making. One final tip. Inside TradingView's Indicators section, search for Elliott Wave tools created by the community. These can sometimes help you identify structures you may have missed. Just remember that no indicator should replace your own analysis. Use them as supporting tools, not as automatic answers. If you're completely new to Elliott Wave Theory, start simple. Focus on identifying 5-wave impulses. Then learn ABC corrections. Then add Fibonacci. Over time, you'll begin spotting these structures naturally across stocks, crypto, forex, and indices. The more charts you study, the easier it becomes. And that's really the secret. Consistent observation and practice. If you found this tutorial helpful, let me know in the comments which market you'd like me to analyze next using Elliott Waves. And if you're learning TradingView, consider subscribing because I publish new TradingView tutorials regularly. Thanks for watching, and I'll see you in the next video.